I read a quote by Hamilton South, former chief marketing officer of Polo Ralph Lauren, who said, "Barry is one of the few guys in private equity who understands brand value." So a question I have for you is, how do you make the determination when branding supersedes the metrics? Because you've been known as sort of a branding genius when it comes to real estate.
Good afternoon, everyone. Thanks for being here. I looked through the list of speakers, and I wish I could have stayed all day today. I should have paid more attention and been here first thing in the morning, and I want to stay after I actually want to get off the panel so I can listen to the next panel. But I think branding is it's overrated and underrated in real estate. It's got value in certain circumstances and no value in others. And I do think, though, that one of the most interesting things for real estate players going forward is going to be social media's impact on property. And if you think it's not a big deal, you know, we've visited companies in Brazil that really sell all their real estate over the web, and using affinity networks on Google search. They've driven their margins far above their peers because their distribution costs are much lower. So I think you're going to see a lot of changes. I argued, I participated in a panel out in Davos at the World Economic Forum several years ago with Phil Knight at Nike and a few other executives in the branding space, and I was at that point still with Starwood Hotels. And we argued about, in this age, were brands easier or harder to build? Given there's so much communication media, so many distribution channels. And I actually think it's much easier to build a brand today than it ever was. If you think about Google, I mean, you didn't know the word 15 years ago, and now there's a person probably on the planet who doesn't know it. 800 million people are members of Facebook. It's the third biggest nation in the world. So I think today you can build brands that is a brand relevant. In the hotel space, brands are very relevant. But you can build a brand. If you look at the Montage, many of you would know the Montage. There's 3 of them now. There was only one in Laguna. You can take Gansevoort. I think everybody knows Gansevoort. There's 3 Gansevoorts. Maybe, I think there might be a 4th in the Turks. I think you can build, because of word of mouth, and it's so easy to get in the channels and get recognized if you know what you're doing in the web and in the media or with great PR. You can create quite a lot of buzz around a brand, and I think it does decommoditize you. And I think in real estate, and like in apartments, Post had a brand, I would say. People would pay $100 more for a Post asset, less because of the brand, but because of what it meant to you as a renter. You'd pay a lot more because their landscaping was the best, and they were known as the most beautiful communities in Atlanta and that region because they just overdid their landscaping. So I think it is an axis of competition. I don't think we're looking at this today as we evaluate assets. I think it's very hard to renovate a hotel to the same brand and get a big pop on performance. I think you can renovate a hotel to another brand and change its entire price points and its entire comp set by changing. I turned the Days Inn Chicago into a W. Right? I took the Days Inn here in the Doral Inn in New York, $107 a night. It became the W in New York at $300 a night. I can't renovate behind the Doral name and get that pop. I can change the entire customer base and change the asset. I don't know if anybody's been successful in the office market in quote-unquote branding. I know the brokerage community would, as you know, would recognize a good owner from a bad owner, but I think the property probably speaks more highly and more importantly, and it can be a single, look at Sheldon Solo, like a single asset, a great asset, it's his asset. But in certain asset classes, I think it is an unexplored access, and I think behind a brand, when we bought the Chorus assets, it's interesting because we tried to brand them. We have 12,000 condos across the United States, and we formed a company called ST Residential, which we parked in Chicago, and every piece of literature says, you know, a project of ST Residential. I don't know if it worked or the market's just recovered. I mean, it's been great, but I don't think anyone paid us for that.
So when you left Starwood, I guess your annual report, you got up and said 2005, it was time to move on. You had 200,000 hotel rooms, Sheraton, Westin, St. Regis. What was it at that time that made you decide to walk away from something that you built like that?
I've done a lot of what I wanted to do in the hotel space. We created W, we created St. Regis. I knew the company was on a roll. We were in a really good price point. I told the board Elmer Fudd could run the company. We were really in a great role. Our brands were gaining market share. Our frequency program had voted #1 in the country for I think 6 years in a row. Actually, one of the things I thought I'd have to do, and I didn't have a partner to do it, was we had done all these innovations at the property level. We did the Heavenly Bed, the Heavenly Bath, the curved shower rods, we did W hotels. We did a lot of that stuff, and I thought the next wave of invention for us, or of differentiation, would have been on the operating side. To do that, I had to dismantle the Sheraton heritage culture, kind of like Nardelli tried to do at Home Depot. And I didn't think I was going to be able to withstand the press I was going to get as I took down the infrastructure of a mediocre hotel company and tried to change the way we operated fundamentally from all the other hotel companies. And I just wasn't ready. I was 45. 45?
45.
45. I'd done it for 10 years. Being public has got its benefits and it has its serious liabilities. And you added in, you were signing financial statements for subsidiaries in Zimbabwe. And the controller, you remember we had Sarbanes-Oxley or whatever it was, and I think they said, tell us if you've been stealing from the company for the last 30 years. I was like, oh, I'm glad you asked. Of course I've been stealing from you. And I was the dumbest thing I ever saw. So, and I was liable for this controller in Zimbabwe, right? And I had a net worth, and I couldn't, the government, in particular, I think a lot of boards got really scared after Enron, and rightly so. But in boards, which you created in public companies for different reasons, so you have a politician, ex-politician, you have diversity. Being a great business person was never a number one criteria for the construction of many boards, and most people don't care. But it got to the point where, as one of my board members said, the business judgment rule had been suspended. Well, if you're actually trying to make an acquisition, you cannot run a company if your business judgment rule. And we start every meeting with the auditor report. Have we stolen from, has anyone stolen from the company? And it got dysfunctional, it was no fun. We couldn't I wasn't getting paid. And, I actually wanted to leave the media. I wanted to leave the Wall Street Journal. I had had enough of, even though I grew numb to some of the things I read about, including the fact that I found out I had a fourth child that I didn't know about from the Wall Street Journal, of all people. I went home and asked, because there's a column that I had 4 kids, I have 3 kids. And asked my wife if there was something she wanted to tell me that night. But there were a lot of things that they wrote about, and it's interesting because there's a recent story by a gal who chronicled one episode for us in the public company. She just wrote a story about, it's in Fortune magazine this week, or November 7th issue, about another fellow that I know very well. And she doesn't have the story right either. But we all read these things, and we think it's true. And one of the hardest things about being a public company CEO is perception. You learn quickly that perception is more important than reality. And you have to manage your perception, and that seemed like a waste of time. I just thought if I could post the numbers and drive the performance of the company, that would be enough.
But one of the things you did there, which was quite extraordinary at the time, it might seem sort of second nature now, is you started this W brand, and at the time, I think that was so novel that you could take I don't want to say lower end brand, but a younger brand. I think you made the statement, this was when I was 45, but W was for me when I was 35. Didn't that sort of entice you to do more of those there?
Well, W is, the story of W inside Starwood Hotels was interesting because we were built by acquisition. So we started out with a bunch of really crappy hotels. And then we bought Westin, and then we bought Sheraton 3 months later. And with that came St. Regis, or one St. Regis. But my goal originally was just to do W, right? Was to build a branded national boutique, differentiated product, something cool, class for the mass, something cool and hip that I would want to stay at when I came to New York. And I was inspired by Schrager's hotels. I used to stay at the Royalton and the Paramount, but I couldn't get a fax. The TV was this big, the bathroom was this big. And I didn't think I have to be uncomfortable. So I thought that if we could merge the two and really, hotels want to run everything. It's their culture, right? They want to run the restaurants, They want to run the golf courses. I'm not going to do that. We're going to bring in an outside restaurateur. We brought in Drew Nieperant's group to do the first W and the second W. And that was everything I wanted to do in hotels that was non-hotel-like, I did in W. In fact, the Heavenly Bed started in W. It was the pillow top mattress we used for the Heavenly Bed, which we branded into Westin, was already in the W's. This is how it should smell, big TVs, Aveda Cosmetics. I was fixing every pet peeve I had in the hotel space with W. And it's kind of cool to see, Bill Marriott said it was just a fad. He walked the New York Marriott, and he called me a kid with a backpack, also in the Wall Street Journal, which I kind of thought was cool. But it turned out, I knew it wasn't a fad. We knew that there was 10% of the population that liked Massimo, that liked cooler things, and that they wanted to aspire to do something, and they'd brand themselves as this customer. It said something about you if you said, I'm staying at the W. And it didn't say much about you if you said, I'm staying at the Marriott, right? Just, it was clean and consistent, the Marriott, but it was never exciting. It was completely unforgettable. And in every other category of goods, that wouldn't be enough to have a successful company, right? And you can't have your shirt doesn't fall apart and that's why you're successful, right? I mean, that wouldn't work. You have to design a great shirt, great colors, great fabric, great texture. So the same thing applied to hotels. How do we differentiate ourselves? The hotel industry had fallen into a trap of differentiating itself on price, right? They did a $79 hotel, a $99 hotel, a $139 hotel, a $269 hotel, but it wasn't being separated on aesthetics. The brands were mushy mush. They were like, you couldn't tell a Sheraton, a DoubleTree, a Hilton, a Hyatt. When you walked inside of them, they all looked the same. So I wanted to create a product, and all the brands followed that. They all got their own look that was different, and that it would have its affinity group. And I think today, in everything we're doing, the whole world is going to these micro affinity groups, where you really have to, you can get a loyal customer base, and if you provide value, you can charge them for that. So with W, I was going for the staff, not the uber sexy. We weren't going for One Oak or the Bungalow 8 crowd, because that was the new thing, and those guys go everywhere. They go from the new to the new to the new to the new, and they're not loyal to you. And those are the page 6
You wanted the JetBlue loyal.
We wanted the staff at W Magazine. We wanted the staff at Condé Nast. We wanted the staff at every advertising agency in the country, in the city. We wanted a more hip, but actually wanted to get the fax, wanted the wireless to work, and it was comfortable. And I think that's one of the things that the boutiques sometimes miss is comfort. You know, the W's were comfortable. Not all of them. Some were better than others, but and the brand actually has a challenge today because it's grown from, I'd say, 3-star assets, and there are 5-star W's, and you can't have a brand when you span that much. But when you span that much quality, you have to have the band of quality for a brand has to be very tight. If you opened a can of Coke and it tasted different every time you drank it, it wouldn't be a can of Coke.
And you could argue the W in Miami is as high end as it gets.
So there was a point where all W development was driven by residential, right? So that was one of the projects where the condo hotel, and so the quality started to creep up, and I had a plan for what to do with that. The company didn't execute that after I left. I'm not sure they knew what my plan was. But and actually a loft, which was supposed to be a lower product, it had a different name also, but changed. But we're talking too much about Starwood.
So let me go back in time, because we have about
Starwood hotels. We can talk about other things.
That's it, we'll get there. We have about 200 students in the audience. So you've had an interesting life. Your father emigrated from Krakow in '39. You attended Brown while your father's plant was sort of having problems. You got your MBA from Harvard, and then you went to JMB for 6 years with all the icons we had on the panel this morning. So I guess I would ask you what you took from all those early experience that might have contributed to your prescience and your success. What lessons did you learn through that period?
Well, this is easy for me. I mean, I think the first thing I learned when I went to work for Neil Bloom, who was on the panel earlier this morning, which was a great training ground. I went to work with somebody who was on the Forbes 400, and I was on the negative $8,000 net worth program when I started. So first thing I thought, I'm going to work for this really super rich guy, and I'm going to learn everything he needs. I'm going to learn all the secrets of being super rich. And I couldn't afford a pair of pants, so I thought it would be really cool. And the first thing I learned is no secrets. It's hard work. I think Neil said that this morning. I wasn't here, but I heard he said, you got to work hard. And you can get lucky. It's always better to get lucky. We love getting lucky, but you create your own luck. So I have all these things. Luck is when preparation meets opportunity. I mean, I really believe that's true. They used to say I was lucky when we took over Starwood Hotels. It started out as a paired shared REIT. We weren't lucky. We knew exactly what we were doing. We didn't pay a premium for it. Patriot American and 2 other guys went out and bought paired shared REITs at huge premiums. We knew exactly what we were doing. It was not luck. We targeted that company. I wanted that structure. I thought I could grow a big hotel company behind that structure, and we turned out to be the largest hotel company in the world in 3 years based on cash flow. So it was not luck, and we were prepared, and we took advantage of the opportunity. The other thing I think is really critical is I had an entrepreneurial finance professor at Harvard who said, find the freight trains in your life and get on them instead of in front of them. And I said, well, that's probably good advice, but I was trying to think, what are going to be the freight trains in my life? And if I was really smart, you think I'm smart, if I was really smart, I just would have been a hedge fund manager. Because what I realized was that compounding institutional capital and pension funds and other passive pools of money, whether sovereign wealth funds, would be the freight train of our lives. They would be trillions of dollars growing exponentially in these accounts. And if I could get in the way of the investing that, but the problem being not being a frustrated artist, I went into property, into real estate, but that's only 3 to 7% of the allocation of institutions it goes to property or real estate, right? The other 60% goes to securities. So I should have been a hedge fund, it would have been easier. But at least I got a small piece of that pie. I just think it's, for me, I was a hedge fund trader, you left that out, and my father said, do you want to look at a little green screen for the rest of your life? It was a compelling argument my dad had. So I thought, oh, well, Dad, okay, I'll go do something else. So, I only applied to 2 business schools for my hedge fund, and if I hadn't gone in, I wouldn't have gone. I would have been a hedge fund trader, probably had a different life.
Less interesting.
Not clear. I didn't have to travel as much.
Right.
So
a few years ago, along with TPG, Perry, Will Ross, and Lefrak, you purchased the 40% equity stake in Coris Bank. FDIC held the remaining 60. I think it was about 61 cents on the dollar. Construction loans and condo projects in South Florida, Las Vegas, Phoenix, Southern California. Supposedly, you outbid your closest competitor by 25%. Was everybody else wrong?
yes. And Steve Ross owes me a dinner. So is he on the next panel?
Yes.
Tell me he owes me a dinner.
I will.
And I'm taking Le Bernardin, something really expensive. So yeah, they were wrong. They were completely wrong. So we bought a $6 billion cost portfolio. The loan book was $4.5 billion, and we paid $2.7 for that. So we paid 37 cents of construction cost. 101 projects all over the country, all mostly high rises, all residential, 1 hotel, 5 or 6 office buildings, mostly in DC. 40 performing loans, 40 non-performing loans, and 21 REO properties. Split about $1.5 billion of our bid price was performing debt. $1.5 billion was, $1 billion or so was the non-performing loans, and then a small couple $100 million of REO. So when we bought this portfolio for $2.7, we borrowed $1.35 billion from the government at 0%. That was really good news. It was 10-year paper at 0%. It's the reason we won. I valued that paper really highly. I didn't know how I could go broke at 0% interest. They also gave us a $1 billion credit facility to finish all the construction and redo the models and replant the trees and grass around our condos and pay the lawyers to get back the properties. So what's happened? It's been about 2 years and 2 months. We've produced $2.1 billion of cash, $2.2 billion of cash. We've sold 5,000 of 12,000 condos. Every single performing loan has performed other than 1, and 8 non-performing loans were upgraded to performing. They've been paid off. We've paid off all the debt. I think we're making about $100 million a month is coming in from sales of assets. We still have 700 or 800 million of performing loans left that are all going to pay off in the next year and a half. We'll have all our money back at the end of this year, and then all of our profits by the middle of 14, I think it is. So we'll make about a 24 IRR, and which doesn't sound fantastic, but we only had 50% leverage on a $2.5 billion, right? So we'll make $1.5 billion on $1.35 billion investment.
You could buy a pair of pants now.
It's pretty good. I mean, we doubled our money, and the government will make an extra. They own 60%, so they're going to make an incremental $1 billion. So the government did well with their structure, and our timing turned out to be better than we thought. The liquidity in places like South Florida, that market, as you know, if anybody pays attention, has been a pistol hot, and it was not Americans. It's all South Americans and Brazilians buying all cash. I'm trying to slow down Richard Lefrak from selling properties. And he's like, we gotta sell. I'm like, no, we don't. We have no debt. When am I gonna have this opportunity again? So, we have no debt. We converted 20 of the condos into multis. Maybe it's 12 or 13. They're now 90%, 95% leased. They're making $30 million. And we want to lever the portfolio. The government doesn't want us to lever it. So they're blocking our leveraging. We could borrow $400 million at 4%, and the government would get 60% of that, $240 million dividend. but they lose 4% on $240 million, which is what, like nothing, $8 million a year, and instead of getting $240 million, they want whole dollar profits. They do not want to have us borrow against this multi-portfolio. So we're going to have to sell it because it's stupid to own it unleveraged.
So in the last couple of years, I think I read you raised about $3.3 billion. I'm not sure how much of that is dry powder. Do you think there are opportunities out there for you that meet your criteria, both for metrics and for excitement, that you can spend that money now?
Yeah, we're really busy. So yeah, I do think we're almost out of money, actually. We closed both of those funds in March of 10, and they're both basically on fumes. If everything closes, so we're out raising a new fund now. And the REIT's been pretty busy, and it's invested about $3.5 billion. And it's already rolled about $1 billion, so it's got $2.5 billion of investments right now. All commercial mortgages, all first mortgage, not all first mortgages, but average LTV of 66%. So it's been very busy the last 2 years. We were very patient. I mean, we've been very busy in the last 3 months. We had a very slow summer. Pricing, I thought, got a little stupid. I thought the debt markets got particularly stupid. So even though it sort of hurts to see the economy slow down and the credit spreads to gap out again, it's actually been very rewarding from a buying perspective, because now we can, I mean, our hotel fund, we had one of our investors say, why aren't you buying more? It's because I'm not buying hotels at 0 caps or 3 caps. And we waited, and now we're buying at really nice cap rates, really lots of hotels. So we're very busy.
Opportunities going forward?
Well, my number 2 partner, Practitioner, moved to London in August, and we decided we were going to get serious. We really had to get serious, and he's on a hiring spree. It's going to be really, Europe is going to implode. There's going to be a ton of stuff for sale. It's inning 1 in Europe, but it might be inning -2. You might be way too early. And I think from a macro standpoint, I'm very nervous about, I'm spending a lot of time thinking about the world, reading about the world, speaking about the world, and it's not just I'm getting older. This is not the world that we had 10, 15 years ago. The range of outcomes, as we say, the tail risks in the world are greater than anything we've ever witnessed before. There's a 25% shot whenever you bake any investment, whether it's in equity, debt, real estate, the world just collapses. That Europe collapses with it, the counterparty risk on derivatives that are unknown to mankind explode, because you just took down a French bank, which was the other side of 400 different Forex trades that JP Morgan holds. I mean, you have no idea where the tentacles of these jellyfish go. And behind that are these Japanese behemoth banks that nobody can figure out. So, and the European banks, well, they lend, I think, 10 times the amount of money the US banks lend to emerging markets, to places like Santander lends to Brazil. So if they go down, Brazil gets hurt, not directly, but indirectly through credit.
You opened an office in Sao Paulo, right?
Yeah, we have an office. We did our first big investment in Brazil recently. We're working on several others. I think there's lots to do. I mean, I think what there isn't to do is probably make 5 times your capital. It's very hard to make huge multiples, and that's what's different today. Without rental growth, other than multifamily pretty much in the US, without rental growth and without leverage, and we won't put the leverage on, not because we can't get it, but because I don't want to lose all our equity. I'd rather put $100 million out to earn a 17, 18 than put 30 out to earn a 24. So we'll make a big, fat, wider poke at the capital stack and give up the chance to make 3 times our equity, because I just don't think you're going to make it. Yeah. So you're going to make thinner multiples of capital, but wider, safer returns. At least that's how we've structured our last couple of funds. Our leverage levels are less than 30% in 2 funds with $3 billion, right? It's crazy. But I can sleep at night. And when Europe rocks, I wake up knowing, okay, we'll lose 100 basis points in our IRR, maybe 2, but we're not going broke. Right. So I think we're constructing our deals and our funds in a different manner than we would have done pre-07, 08. And it's really a function of, I think, the world's a different place. I mean, there's so many more, no, the worst thing about the world is the future of the world is in the hand of politicians right now. What could be worse? Right? It's not, businesses are doing great. CEOs are actually optimistic. Companies are sitting on trillions in cash. Their profit margins are as wide as they've ever been. Their stocks are not that great, but they're not worried about it. But everyone is nervous, and that is affecting the global economy. Long term will be fine, but this turbulent period, this is one volatile mother right now. I mean, you wake up and you're like, It's like you're clawing at your bedspread. You're watching CNBC and see the futures down 1,700 points. You're like, it could happen any day. And none of us would be surprised. If you're reading the paper, you read the headlines. If you just drop from Mars sometime and look at the Wall Street Journal today, you kill yourself. You're like, I gotta sell everything in the morning. And none of us have sold everything we own. But it is, I was with the president of a major investment bank last night and a former president of the United States. And they were both saying they think Europe is going over the edge. And I was like, oh, that's not good. So, it's like, you just really, really depressed me. I keep thinking that, any rational human being would say we all know that the European debt has to be cut, has to be extended. We can get through, just like the U.S. deficit, we can get through this problem with leadership and a plan, right? No problem. It's like credit. You can extend credit for a long time. It'll work. We all got our credit extended, and we work through our problems. But in Europe, you're relying on politicians, and that throws a wild card into this that business people don't understand. Really, we don't understand the trade-offs of I'm not voting for that, even though I know it makes perfect sense because you didn't vote for me for the chair of that committee 14 years ago. You're like, is that relevant? While the whole world melts, you're worried about a committee appointment from 14 years ago, and congressmen do that stuff. I've witnessed it. I can tell you, it's true. It's sad, but it's true.
I read that when Eddie Lambert bought Sears, you said, why didn't I buy that? Whether that's true or not, I guess the question I would ask you is...
Whatever you read is pretty good.
I guess the question I ask you, is there one big deal that you missed, that you regret missing because you either didn't get to see it or you bid too low, or...
Well, in this cycle, extended stay hotels. We bid on that. The bidding started at $3 billion, and started at 10 o'clock on a Thursday and ended, late 09 at 5 o'clock in the morning the next day. Our funds weren't big enough to make the investment. I knew what we would do with the company. So our share of the capital, we teamed with TPG and with, I think 5 Mile, was $900 million equity check. And that we've done a $900 million equity check. Societe de Louvre was $900 million, but that was 05. The world was in no position in 09 for us to do a co-invest for $500 or $600 million, which we did do in Societe de Louvre successfully. So we lost the deal. I knew we shouldn't have lost the deal. We stopped. It was intuitive more than on paper. I kind of thought we were at the trough of the cycle. What happened for Blackstone and Paulson and Centerbridge is that in August of 09 when we bid, the most we could get from the banks was $2.2 billion of financing. And Mr. Blumenthal's here. I mean, Deutsche Bank and JP Morgan were on the other side backing the other guys, and they would only lend $1.8 billion. So we had 2.2 from Citi and Goldman Sachs. An incremental leverage was going to cost us like 20%, which was like too high. I never borrow like that in hotels. So at 3.925 plus closing costs, we were putting up $1.8 billion of capital of equity. So it was one-term leverage. By the time they closed that deal, it didn't close till November, late November of 09. The credit markets had rallied so hard that they were able to borrow 2.7 or 2.8, which meant our equity check would have shrunk, our IRRs would have gone up, and our multiple would have been better. And then it was a perfect timing. If that company had collapsed a year later, the creditors would have recovered another $1.5 billion. I mean, it was a joke of an auction. It was a terrible friggin' process. It was terrible. It wasn't. We actually were bidding to be the stalking horse bidder, and there was no auction in the bankruptcy court. There was a breakup fee. I tried to break it up after we lost, and the judge said, "You lost." I said, "We didn't lose. That was just a stalking horse plan." When we bought Sea Island, Georgia recently, we lost the stalking horse bid, and we bought it in bankruptcy. We went to the auction, us and Avenue and Oak Tree, and we bid against each other as it's supposed to happen. In the ESA bankruptcy, there was no auction in the bankruptcy court. The judge just got tired.
So I'm going to open the floor to questions. We have a few minutes left before our next and last panel. So I can't see that well out there.
I can see that.
Rob?
The question was, what was my view on China? I've been involved in China for 15 years or so because I went with a hotel company to open the St. Regis in Beijing and then in Shanghai. And then we did our W's in the Westin and the Bund in Shanghai. So I've been going back and forth for years. I've always said that get over it, China can produce any GDP they want. They have $3 trillion of reserves. They're a rich nation. Banks are an arm of the government. They subsidize their development and expansion into infrastructure, mining, agriculture, whatever they want to do, they borrow it. Our companies have a cost of equity. They really don't. They have the 5% cost that the banks charge them, and the banks are told what to do. The economy's getting a little away from them. There's a lot of black market stuff going on, and there's a lot of lending that happens away from the government, which pisses them off, and it's why they have had trouble slowing the economy. But their investments tend to be real. And in terms of the infrastructure investments, the 20 airports, the ports, the high-speed rail, the highways. If you've been there and you've seen the new airport in Shanghai, I mean, these are not the kinds of things my road in Nantucket has been paved 7 times with his stimulus package. We've stimulated that 7-mile road 700 times. I mean, it's enough, right? Every road in Connecticut has been paved. Everything. I tried paving my driveway last night. I'm not part of this program. So, I mean, the Chinese are doing real projects with their stimulus, and that bodes very well for that country long term. And I tell people, and I've quoted as saying it's a company masquerading as a country. I mean, they have a program, and it's not your program. They're not on the 5-year IRR program. They're on the 50-year and 100-year development and how I'm going to get 200 million people off the farm into the cities. And what I find fascinating about China and why we don't really do much there is because I can't really understand demand, right? And I can't really see supply because they're building on, they don't care about your 5-year IRR. They just don't care, right? I was partners with the Ministry of Finance on this hotel. They said, you got to build apartments behind it. I said, I don't want to build apartments. Li Ka-shing is building 14 million units right next to me. And what, can I do a market study? We don't do market studies in China. Essentially what they said, there are people. They'll be here, right? It's not like Abu Dhabi or the Middle East, right? Right? So when you build hotels in Beijing, and you see these hotels, they overbuild the market. You're like, you need another hotel? Didn't you have a Hyatt? You need a Park Hyatt and another Hyatt and a third Hyatt and another, all in one. And you know what? They're empty, and then a year later, they're full. The office buildings in Pudong are empty. Like, who's going to use all these? And they're full. This is a program without a lot of transparency, certainly to us, right? And the scale of the movement of people into these cities, the scale of industrialization, Chinese style, is the world has never seen before, right? You have no comp. And so I kind of scratch my head. I really don't know what to make of it. You hear guys saying, I know there are cities in China that look like Thailand, where there are buildings with no roads to them, and there's buildings that are completely see-through, and they force a lot of Chinese investors to just buy apartments because they can't do anything else with their money, and they like property. This is a nation of people who like real assets. They like hard assets. But as they will be forced to raise the currency, they will become more expensive as a competitor. They will make a hell of a great competitor. They have all new equipment, all new infrastructure, they keep fixing their Achilles heel, which is their access to natural resources. They're on a program. This is a very worthy competitor, and they are rich, and you are poor, and you need them. So stop kicking your banker in the face by telling them, all the time that they're currency manipulators or whatever. We do benefit from this. That currency is not where it should be. Everyone knows that. But I'm not sure how we're handling this. I mean, this is a gentle ride out of this problem, because if they revalue that currency, everything in Walmart goes up 20% in cost. I don't think Americans, the average American, the have and the have-nots, which really shop at Walmart, they're not going to enjoy that at all. So you got to be careful. I think China will be fine.
Last question. Give us your perspective on New York as it relates to investment opportunity and what you think of the city.
So you asked me things I've learned. I mean, I learned watching Neil that the flow of funds overwhelms fundamentals, and people want to own New York. And the world wants to be here. Capital is stuffed in the Middle East. The collapse of Europe, that has one huge benefit. People want to invest all the money they were spending in Paris and London here in the US. And I had drinks yesterday with a fellow from Egypt, and he was saying, you don't understand the amount of money that wants to come here. And they want to come to New York. This is when we as Americans invest, and we have an office in Paris and London, we buy Paris and London. We don't spend a lot of time in Leeds and Lyon and Bruges, or even, we owned a building in Marseille, so I shouldn't say that, but most places we don't buy, right? When foreigners come to the US, they know New York, right? It shouldn't surprise people that they don't know where Fort Lee is, right? They just don't care. It's going to be, I like Fort Lee. If you're Korean, you know where Fort Lee is. Fort Lee is a wonderful town, but it doesn't sit well in the annual report of Adi Nautic. So, they want, and by the way, if you're them, you have to get out of your U.S. mindset, right? A 3% cap rate looks stupid unless you're 5 years at 0.88, right? And then they have an inflation protection too. So I think cap rates stay tight. I think the world stays looking for yield even after whatever the hell happens in Europe. I think property is in a very interesting point. We usually, to me, are the second most interesting asset class behind the equity markets. And the equity markets look cheaper to me because the companies are good, they have great growth platforms. But as a major asset class, this is definitely way ahead of everything else right now because you are buying property cheaply, relatively speaking. You can get positive leverage. You can borrow cheap. You can't borrow negative leverage right now. And you have a kicker on inflation. If inflation hits, you're going to do better than you underwrite. And it's one of the few asset classes that probably, now hyperinflation, we're done. So this is the Weimar Republic. I'll see you we'll be mowing lawns together. So I like lawns. It doesn't cost much to surf. So we'll go surfing. I wanted to learn how to surf.
Great.
So
Barry Sternlicht, thank you very much.
Thank you very much.